The focus of this report is really whether African markets are cheap or expensive as judged by market multiples. So a common way to measure whether markets are cheap or expensive is to look at one of several multiples. Those of you familiar with the listed markets will be very familiar with the PE multiple, but in private equity, the most commonly used multiple is an enterprise value to EBITDA multiple. So it's a ratio of how much you would pay for a company compared to what the earnings of that company are. So the multiple represents a balance of the growth expectations of an asset and the risk to the earnings of the asset. So in high growth markets, you may get high multiples, but that would be balanced out by the investor's perception of the risk in those markets, which would be pulling your multiples down. So when we look at developed market multiples, multiples certainly increased with the confidence ahead of the financial crisis, but took a serious dip when the financial crisis hit. Multiples fell sharply as investors reevaluated this risk profile, even through developed markets. What's quite interesting is how quickly the markets rebounded after this time, except for Japan, which has seen still remaining low levels of confidence. So the earnings multiple in developed markets has averaged over the last 10 years or so between 8 and 9 times. Without Japan, it would average around 9 times between the US and the UK. Looking at the BRICS, multiples in China have been at very high levels, averaging 17 times EBITDA over the last 10 years, and supported by very high growth. As we saw in the previous slides, they've actually delivered to a large extent on that growth. However, multiples have begun to come down, as some of those growth assumptions have come down over time. Brazil and India are showing lower multiples, averaging around 7 to 8 times over this period, while the higher risk perception of Russia has seen their multiple lag the rest of the BRICS. Looking at African markets, to a certain extent, Nigeria has been our China. Up to the financial crisis, the multiples on the listed market in Nigeria went up to around 22, 23 times, but have dipped substantially through the crisis and haven't really recovered since then, and are now at much lower levels. What we have seen is multiples rebounding as markets have rebounded early in 2013 throughout Africa. There's been some nice returns that have come through on the listed markets in the first quarter. So multiples traded in Nigeria and Kenya between 2009 and 10 were in the range of 6 to 9 times, while multiples traded in Egypt over that period were more in the range of 10 to 12 times. So multiples through Egypt have been quite high as well, which is interesting. Interesting to see how they have performed as the revolution started in Egypt, and that they actually haven't been hit that hard as you might expect. What is clear from this analysis of the listed markets is that all markets have been negatively affected by the 2008 global financial crisis, with similar trends in the level of multiples. So Africa has certainly not been an exception to this, with multiples dipping sharply in 2008 and then partially recovering. This recovery has been a bit weak, as investors' risk aversion has kept money flow out of the continent from an international perspective, while other global emerging markets have reverted to more of the longer-term averages. So at the end of our data period here, which is at the end of 2012, African markets were still priced far below their 10-year average of 8 times. They were priced at 6.3 times at that point in time. But as I said, early in 2013, markets have rebounded a bit to close some of that gap.